All right, guys, welcome back to another class. In this episode, we're going to be talking about technical analysis and what it means to a lot of different areas. It's a viable part in trading, so it's a topic we're probably going to be covering over the next many classes. In a sense, it's something that it pretty much shows the history of a play. It's all about building that hypothesis or the predictions of what this play is going to do according to its history, and a chart, and knowing the chart and the patterns and the way they're set up will tell us everything about supports, resistance, our entry, and what it's done in the past. Technical in the chat room this is all he trades, does very well with it. So me, as more of a fundamental trader with OTC, it's more in line of trading with OTC is fundamentals. But when it comes to big boards, it's very crucial to know about technical analysis and how it can be very useful into making good positive trades, predictions, and hypotheses on how the chart is building. So we're going to go ahead and get started. What is technical analysis? Technical analysis is a tool or method used to predict the probable future price movement of a security, such as a stock or currency pair, based on market data. The theory behind the validating of technical analysis is the notion that the collective actions, buying and selling of all the participants in the market actually reflect all relevant information pertaining to a traded security, and therefore continually assign a fair market value to the security. Past price as an indicator of future performance. Technical traders believe the current or past price action in the market is the most reliable indicator of future price action. Technical analysis is not only used by technical traders. Many fundamental traders use fundamental analysis to determine whether to buy into a market, but having made that decision, they then use technical analysis to pinpoint good, low-risk buy entry levels. And this is kind of how I play, okay? I'm looking for those fundamentals that are going to be a good catalyst for play, okay? And fundamentals are things that'll make the play move according to market prediction of interest, news, filings, anything that could pertain to making a certain sector or the specific stock rise because of the brought to interest because of something the company is doing or something that has been brought attention to this company or sector. And you got to use technical analysis of, building a chart to know a good entry and exit level, and knowing your supports and your stop and your resistance. And, I use these pivots. They're very easy to predict by just glancing at them. You've got some good positions here, but also you're going to see lows and highs, and it's going to help you determine what this chart is doing. And you're going to look at your volume bars as well, and it kind of tells you what the sentiment is creating for this play. So in long here, or in short, got to use technical analysis to help those entries and exit points. And it's how I predict kind of a price target according to what the play has done in the past and what resistance it has to break in order to achieve that price target. And of course, it all comes down to the market playing it out, according to volume associated with this play. A lot of fundamental players will play these plays according to, or I should say technical analysis players will play these plays according to how the chart is set up. Charting on a different time frames. Technical traders analysis price charts to attempt to predict price movement. The two primary variables for technical analysis are the time frames. Consider and the particular technical indicators that a trader chooses to utilize. The technical analysis time frames shown in a chart range from 1 minute to monthly or even yearly time spans. Popular time frames that technical analysis most frequently examine include a 5-minute chart, 15-minute chart, hourly chart, 4-hour chart, or a daily chart. I'm going to go ahead and give you some examples. Now, this right here, we're going to be looking at a 5-day. Where's my minutes? Right here. 5-minute chart. Let's say we want to do a 30-minute chart. This is adjusting the candles differently, okay? Each candle represents 30 minutes of the chart, okay? When you look at a 30-minute 5-day chart of this, it just looks like a solid pump and dump. We're going to change that to a 5-minute chart, and it's going to be a little more in depth of how this chart is really playing. Each candle represents 5 minutes. So in a sense, it's it kind of gives you a little more detail instead of roughly. You want to pick an hour chart. Let's say it's an hour. It's just going to be a little bloop into the common denominator of the stock. So let's say we want a 6-month analysis of this chart. Okay, we're going to go ahead and pull back. Let's say we're going to go a 30-minute time frame on a year to date. And you're going to know the history of this play since, as far back as you want to freaking go. It has never made these kinds of moves since, the beginning of time of it, pretty much. And when you guys start getting too far back and you see astronomical rises in the stock like this, all this tells me is it's either had a reverse split or this is data not recognized. Obviously, this is in 2011, 2008. I'm going to find the freaking top. Here's $30. And a lot of people look at these and like, oh man, this play's really hit that high before. No, it's a combination of reverse splits that will make this play look as if it did it. I mean, you look at the top here. You think this play really reached $65,000 a share? Not hardly in 2001. 2000. So pretty much it's very inaccurate data. What you want to look at when you want to look at charts is pretty much let me go ahead and X out this chart and redo it again. You pretty much want to look at I goofed up my whole chart altogether. Yeah, never mind. Let's pick a new chart. So in a sense here, you're going to be looking at different time frames. I prefer a 5-day, generally 5-minute time frame, okay? It's pretty much set at a 5-minute on a 5-day chart. And a lot of people like a 3-month chart. So pretty much is going to give you back up to 3 months. Here's April. It's going to kind of show you what this play has done in the past. I think it's 15. No, it's 1 hour. Let's go to 30 minutes. So this is going to get you back all the way 3 months to current and kind of give you an example of how this play is played over the past 3 months. Obviously, it has not had catalysts in the pasture for a while. So in light, you kind of want to reflect, how it's played out. And like I was showing yesterday in our other class, you're looking at that entry point that you're early. There's obviously not a ton of loading through these past days compared to what, it did earlier. So you want to judge off how loaded the play is before you've gotten in. And that you're not just buying a bunch of shares and you're late to the game. So in light of that, different charts show you different ways of looking at a chart. And my ideal one is the 5-day, 30-minute time frame or 5-minute time frame. The time frame a trader selects to study is typically determined by that individual trader's personal trading style. Intraday traders who open and close trading positions, and with a single trading day, favor analyzing price movement on shorter time frame charts, such as the 5-minute or 15-minute charts. Long-term traders who hold market positions overnight and for long periods of time are more inclined to analyze markets using hourly or 4-hour, daily, or even weekly charts. So yeah, you will have those guys that want to just swing trade forever. Let's just pick a stock, okay? In this sense, they want a good year-long chart. It's going to show you pretty much what this thing has done over the course of a year. And, this is obviously Microsoft. It's a big stock. So, you're looking at pretty much determining the overall trend of this play. And look, we're doing nothing but up. I mean, freaking great play to put in your retirement fund, so to speak. So, you're looking at those entries at lows and highs when you're buying it at, and you get an overall picture of what this chart is really portraying, a very solid history. You could have different plays to, what's a good play? I'll just give you another example. Okay, here you can kind of see what this play is kind of done. Okay, back to 2017. We can stretch these out a little bit. You can kind of give a little bit of resemblance of it. It's had massive pops up and down, up and down, up and down, but it does not have that continual growth as you would put in something that has legitimate force behind it. That's, it has continual growth for the play. There's a reason for its continued growth. It's a big company. It's obviously advancing. So, and those lights, different time frames, different charts can help you determine what's the overall direction of some plays. Price movement that occurs within 15-minute time span may be very significant for an intraday trader who is looking for an opportunity to realize a profit from price fluctuations occurring during one trading day. However, that the same price movement viewed on a daily or weekly chart may not be particularly significant or indicative for long-term trading purposes. It's simple to illustrate this by viewing the same price action on different time frame or charts. The following daily chart for silver shows price trading within the same range for roughly $16 to $18.50 that it's been in for the past several months. A long-term silver investor might be inclined to look to buy silver based on the fact that the price is fairly near the low of that range. Okay, this has got a kind of a close range. Okay, this is only looks like a several month range. Yeah, from February to June. So you've got it in here, but when you come down here, you're going to see that it's got an overall downtrend apparently from June 2017 to, let's see. Yeah, that's 2017. This is 2000, I guess, 2020, 2000. I'm not sure on that one. However, the same price action viewed on an hourly chart below shows a steady downtrend that has accelerated somewhat just within the past several hours. A silver investor interested only in making an intraday trade would likely shy away from buying the precious metal based on the hourly chart price action. Candlesticks. Candlesticks charting is the most commonly used method of showing price movement on a chart. A candlestick is formed from the price action during a single time period for any time frame. Each candlestick on an hourly chart shows the price action for 1 hour, while each candlestick on a 4-hour chart shows the price action during each 4-hour time period. Candlesticks are formed as follows. The highest point of a candlestick shows the highest price of security traded at during that time period, and the lowest point of the candlestick indicates the lowest price during that time. The body of the candlestick, the respective red or blue blocks or thicker parts of each candlestick, as shown in the chart above, indicates the opening and closing prices for the time period. If a blue candlestick body is formed, this indicates that the closing price top of the candlestick body was higher than the opening price bottom of the candlestick body. Conversely, if a red candlestick body is formed, then the opening price was higher than the closing price. Candlestick colors are arbitrary choices. Some traders use white and black candlestick bodies. This is the default color format and therefore the one most commonly used. Other traders may choose to use green and red or blue and yellow. Whatever colors are chosen, they provide an easy way to determine at a glance whether price closed higher or lower at the end of a given time period. Technical analysis using candlestick charts is often easier than using a standard bar chart, as the analysis receives more visual cues and patterns. Okay, I'm going to show you what a bar chart is. In this sense here, let's say you've got, I'm going to go ahead and do my 5-day. It's a little more instinctive. You see the candles. Not on this chart, though. You see the candles here, and in a sense, these are each bodies of that time period, okay? I've got this on a 5-minute time period, so every 5-minute time period, this move has moved up from 0.0027 to 0.0032 in literally a 5 minutes time. And this is the volume that created that movement, and so on. So it's created that body, and that's kind of its high and then its low during that time frame. After another 5 minutes, another candle is formed. In this sense, let's say, I think I can change my candlesticks. Yeah, let's do a line, okay? So in this sense, you see a line, and it's showing kind of the direction. Some people like to use line, but it does not show me, you know, the upward direction as the line is being formed. I'm just kind of judging off the direction or angle of the line. And you're going to have a lot of different other candles. Some people like bars. You're going to have up and down bars. It's very hard to distinguish. It's not quick for me. You know, this will kind of give you an area, so to speak. Still kind of a line, not really a fan. And you kind of got this, okay? Kind of easy to judge in a sense. It just shows buying and selling, buying and selling, buying and selling. This is another very funky kind of candle, so to speak, but it's not really like a candle, but some people can play it. If they see, let's just say they see the start of this red one, then automatically they're going to start assuming it's going to be a bunch of red ones in a row. And it's kind of showing a obvious sell-off, so to speak, for each sector. And you know, as you're trading, I generally do a lot of buying and selling on my phone. I do all the buying and selling on my phone. So pretty much it's, you know, I'm watching the charts during intraday and knowing what the price movement is doing, and I can judge it and be ready to sell or buy according to what the price movement is changing in front of me. I go back to my candles. I use the Heiken Ashi candles. They're the most, you know, easiest ones for me to represent. Candlesticks and drawn. Okay, I've covered that. Candlesticks are drawn and formed as follows. The highest point of a candle. Okay, candlesticks are color. Okay, we've covered that. Candlestick patterns. Okay, the Dojis. Candlestick patterns formed are which by either a single candlestick or by a succession of 2 or 3 candlesticks are some of the most widely used technical indicators for identifying potential markets, reversal, or trend change. Doji candlesticks, for example, indicate indecision in a market. That may be a signal for an impending trend change or market reversal. The singular characteristic of a doji candlestick is that the opening and closing prices are the same, so the candlestick body is a flat line. The longer the upper or lower shadows or tails on a doji candlestick, the part of the candlestick that indicates the low to high range for the time period. Excuse me. The stronger the indication of market indecision and potential reversal. There are several variations of a doji candlesticks, each with its own distinctive name as shown on the illustration below. Okay, pretty much this is a wick. I call these wicks. There is no candle body, okay? And in this sense, you're going to see it here on the chart, okay? You're going to have these wicks underneath the body of the candle. That means there was indecision there was very indecision that they wanted it down this high, indecision they wanted it down this low, down that high, down up that high. And obviously you see a very neutral one right here, okay? During that 5-minute time period on this candle, on these candles, there was no up or down. It was very kind of neutral, okay? And it's pretty much determining the direction of the trend or the play. And as the trend continues, you know, we ended the day with this candle, so to speak. It's on support. It's on, you know, it was just a clear little red sell-off right here. It shows you on volume. There was a little green buy. Could have been a paint job, and it was painted down, so to speak. And it just ended there. There was no indecision. There was a definite decision. They wanted red, okay? Obviously neutral here. So it gives you kind of ideas. Watching those candles can be very, you know, useful. In a sense, this is nothing but bullish, okay? It's just popped up, and it's just green, and it's dragonfly bullish. Gravestone bearish ended on a bearish note, or for price, in my opinion, is just a neutral phase. long-legged indecision. You know, let's just say the price jumped up here, it jumped up there. The wick is created by the directional move of the middle pivot of the candle, okay? When you come to this, the candle never went up or down. It just stayed neutral during that time period. And in here, the candle did go up, but it went all the way down here, and this is where it finished the time period out. There was no body of play. It was just everybody said down, okay? We're down. Everybody said up, we're up. No decision during that 5-minute period to show that they went up or down there. We're just going to stay neutral. The typical doji is a long-legged doji, okay? This one right here, where price extends above equally in each direction, opening and closing in the middle of the range for the time period. The appearance of the candlestick gives a clear visual indication of indecision in the market. When a doji like this appears after an extended uptrend or downtrend in a market, it is commonly interpreted as a signaling a possible market reversal, a trend change to the opposite direction. Now, yeah, you will see these candles when they, let's go back to our chart. When, let's say, the stock has made a bullish run, okay? You kind of see it right here, okay? There was some indecision. Obviously, a lot of bulls pushed it up here. It got painted up there a little bit, and it come down. Our next time frame shows a very neutral phase, okay? It's a long-legged doji, okay? And in this sense, it shows there's indecision, but it's obviously red because it's lower than the last time frame. So it indicates a lower trend there, and it's indecision of should this continue or should this reverse. And a lot of people, when I see that candle, it kind of signals to me that I need to sell. You're going to see it right here as well. Okay, during this bullish run, this one was a green one, but it still was there, and it was even another one in that time frame. It kind of shows me, okay, maybe this is a reversal. You're going to watch the next one, and you got to be careful because you're going to know your support and resistance lines. Okay, and that helps you determine if you want to hold it, and depends how big of a span that is comparatively. But obviously, there was some indecision. There was some sell-off, and buyers took back over again. And after another run, what do you know? There's another one, okay? It's indecision. It's like a consolidation period. It's kind of like a neutral phase, so to speak, okay? And at the end of every single one, you're going to have that neutral candle, okay? And it's pretty much, it's that indecision candle. And it's important to know these candlesticks sometimes when you're watching intraday movements, okay? And obviously one right here, right before a bullish trend. You're going to see it before a bullish trend as well. Every time before a bullish trend, you're going to see it right there. And bearish, it's going to be vice versa. So the long-legged doji is kind of the most important candle. The dragonfly doji right here, when appearing after a prolonged downtrend, signals a possible upcoming reversal to the upside. Examination of the price action indicates by the dragonfly doji explains its logical interpretation. The dragonfly shows sellers pushing price substantially lower. The long lower tail, but at the end of the period, price recovers to close at its highest point. The candlesticks essentially indicates a rejection of the extended push to the downside. The gravestone doji's name clearly hints that it represents bad news for buyers. This one right here. The opposite of the dragonfly information, the gravestone doji indicates a strong rejection of an attempt to push market prices higher and thereby suggests a potential downside reversal may follow. Let's see if we see any dragonfly or doji or graveyard dojis. I don't really use those much. It's always the long-legged one. I've always pretty much use an OTC. Now you might see it in some NASDAQ stocks, something with very fluid movements. Okay, you're going to see that chart again. The long-legged dojis. I'm not really seeing any of those, but you'll see them intraday before a candle body is made. The four price doji where the market opens, closes in between, conducts all buying and selling at the exact same price throughout the time period is the epitome of indecision, a market that shows no inclination to go anywhere in particular. Okay, it's this one. It's just a flat straight line. No candle was formed. It was just pretty much a flat line. There are dozens of different candlestick formations, along with several pattern variations. Probably the most complete resource for identifying and utilizing candlestick patterns is Thomas Bulowski's pattern site, which thoroughly explains each candlestick pattern. Each provides statistics on how often each pattern has historically given a reliable trading signal. It's certainly helpful to know what a candlestick pattern indicates, but it's even more helpful to know if that indication has proven to be accurate 80% of the time. Technical indicators, moving averages. In addition to studying candlesticks formation, technical traders can draw with a virtually endless supply of technical indicators to assist them in making trading decisions. Moving averages are probably the single most widely used technical indicator. Many trading decisions utilize one or more moving averages. A simple moving average trading strategy might be something like this: buy as long as price remains above the 50-period exponential moving average, EMA. Sell as long as the price remains below the 50 EMA. Okay, I'm going to go ahead and show you what a 50 EMA looks like. Yeah, this is not the correct one. I wanted the simple one. Why do they got to make it so difficult? Go ahead and remove all indicators. I'm just going to do an MA in this sense. All right, here's what your moving average looks like, okay? It's pretty much, let's just say this is our 50-day moving average. It's obviously under the 50-day moving average here, showing a sell-off, and it's climbed above the 50-day moving average. It rides along that 50-day moving average as long, and as the trade is continually going, you can go ahead and see how active it is, and it seems to be, obviously we broke below the 50-day moving average here and here, but we're riding above it. Broke below it, but we're riding above it again. Broke below it, riding above it. A lot of people like using this 50-day moving average, and obviously massive sell-off. It broke through. It come back up. It's broke through. It broke down. It's obviously end of the day coming back through and resting on it again. Okay, this line represents the 50 days of the moving average, so to speak. So some people like to use it. It kind of is an indicator to distinguish, selling or buying according to that line. And it follows that line very closely. And obviously it breaks below it many times. I think there's even, you can do even 200 days. $200 days don't move near as much. Okay, it's taken 200 days for this to ever move it. But 50 days, 30, 50 days is kind of all you need. Moving average crossovers are another frequently employed technical indicator. Crossover trading strategy might be to buy when the 10-period moving average crosses above the 50-period moving average. The higher a moving average number is, the more significant price movement is in relation to its considered. For example, price crossing above or below a 100 or a 200-period moving average, just like I showed you, is usually considered much more significant than a price moving above or below a 5-period moving average. Technical indicators, pivots, and Fibonacci numbers, okay? That's what I like is my pivots, okay? And in this sense, this is what we're using as pivots. Why is it showing funny over here? Anywho, oh, that's Microsoft. So having those pivots are very helpful. We're going to go back to 5-day. It's going to be a little more specific showing it. The pivots are showing me pretty much the hard resistance, or hard supports for the chart to pretty much work its way through. Daily pivot point indicators, which usually also identify several support and resistance levels in addition to the pivot point, are used by many traders to identify price levels for entering or closing out trades. Pivot point levels often mark significant support or resistance levels, or the levels where trading is contained within a range. If trading soars or plummets through the daily pivot and all the associated support or resistance levels, this is interpreted by many traders as a breakout. Trading that will shift market prices substantially higher or lower in the direction of the breakout. Daily pivot points and their corresponding support and resistance levels are calculated using the previous trading day's high, low, opening, and closing prices. I'd show you the calculation, but there's really no need, as pivot points levels are widely published each trading day, and there are pivot point indicators you can just load on a chart that do the calculation for you and reveal pivot levels. Most pivot point indicators show the daily pivot point along with 3 support levels below the pivot point and 3 price resistant levels above it, as I was just showing you. Fibonacci retracements. I'm going to see if we got a Fibonacci indicator in here. Now, these are the Fibonacci retracements, okay? They kind of run off of a different percentage. Some people use them. Obviously, this chart is probably wouldn't work too well with OTC, I don't think. I'm not sure how many people actually use the Fibonacci retracements for OTC. Fibonacci levels are another popular technical analysis tool. Fibonacci was a 12th century mathematician who developed a series of ratios that is very popular with technical traders. Fibonacci ratios or levels are commonly used to pinpoint trading opportunities and both trade entry and profit targets that arise during sustained trends. The primary Fibonacci ratios are the 24, 38, 62, and 76%. These are often expressed as percentages. Yeah, this is just saying 23 and 38, etc. Note that Fibonacci ratios complement other Fibonacci ratios. 24% is the opposite or remainder of 76%, and 38% is the opposite or remainder of 62%. As with pivot point levels, there are numerous freely available technical indicators that will automatically calculate in low Fibonacci levels onto a chart. Fibonacci retracements are the most often used Fibonacci indicator. After security has been a sustained uptrend or downtrend for some time, there's frequently a corrective retracement in the opposite direction before price resumes the overall long-term trend. Fibonacci retracements are used to identify good low-risk trade entry points during such as retracements. For example, assume that the price of a stock A has climbed steadily from $10 to $40, and the stock price begins to fall back a bit. Many investors will look for a good entry level to buy shares during such a price retracement. Fibonacci numbers suggest that likely price retracements will extend a distance equal to 24, 38, 62, and 76% of that trend move from $10 to $40. Investors watch these levels for indications that the market is finding support from where price will begin rising again. For example, if you were hoping for a chance to buy the stock after approximately a 38% retracement in price, you might enter in order to buy around the $31 price level. The move from $10 to $40 equals $30 or 38%. Of $38 is $9. $40, take away $9 equals your $31. So that kind of indicates that, okay, it's got to fall back that 38%. You take away $9 from the current share value of $40, and that means that you put an entry price of $31. That's pretty much going to be your support. And 38% is pretty popular if you're looking at an indicator. Let's go back to a big board stock. I think it's going to be a little more easy to display. So right here, This is a good section. Okay, it broke out, but you want an entry before it's run up, okay? And I think this is 24.38. I'm not sure the percentages on these. These are all the different levels of Fibonacci levels. And you can let's say you want to do on the orange one right here. I'm guessing that may be 38. But you know, the price was at 138 here. It's come down to 137 there, and that equates for your entry level. And obviously, it's riding that orange one pretty well. Obviously, dropped below there. But you know, I don't use indicators. Like I said, I'm just a pivot guy. That's pretty much the most common thing for me. It's the most accurate thing for me when it comes to OTC. But play around, you know, get yourself a trading view. It's free. I think they limit you to 3 indicators per chart, unless you do their paid version and you get unlimited or so many indicators per chart. But play around with it. I mean, see what works for you guys. And TradingView, it's a great trading software. It's one like I said, it's one I always use. Of course, I'll go ahead and delete these. You got a basic chart, and like I said, it's always in templates. It's a swing trading template that has the pivot set up for you. Okay, it's already calculated in there. I like it. It shows me everything I need when it comes to OTC. But play with it, see what works for you guys and what you like. Fibonacci extensions. Continue with the above example. So now you've bought the stock at $31 and you're trying to determine a profit target to sell at. For that, you can look to Fibonacci extensions, which indicate how much higher a price may extend than the overall uptrend resumes. The Fibonacci extension levels are pegged at price that represent 126, 138, 162, and 176% of the original uptrend move, calculated from the low of the retracement. So if a 38% retracement of the original move from $10 to $40 turns out to be a retracement low, then from that price, $31, you'll find the first Fibonacci extension level potential take profit target by adding 126% of the original $30 move upward. The calculation goes as follows. Fibonacci extension of 126 equals $31 plus $30 times 126 equals $68, giving you a target price of $68. Once again, you never actually have to do any of these calculations. You just plug your Fibonacci indicator into your trading software, and it displays all the various Fibonacci levels. Pivot and Fibonacci levels are worth tracking, even if you don't personally use them as an indicator in your own trading strategy, because so many traders do base buying and selling moves on pivot and Fibonacci levels. If nothing else, there is likely to be a significant trading activity around those price points, activity that may help you better determine probable future price moves. Technical indicators, momentum indicators. Moving averages and most other technical indicators are primarily focused on determining likely market direction up or down. They're in another class of technical indicators, however, whose main purpose is not to so much determine market direction as to determine market strength. And my version of market strength is watching my level 2. Now, a lot of people can't read level 2, but it's something you've got to learn to read, and it's very helpful when it comes to market strength. These indicators include such popular tools as the stochastic oscillator, the relative strength index, the RSI, the moving average, the convergence divergence MACD indicator, and the average directional movement index, ADX. By measuring the strength of price movement, momentum indicators help investors determine whether current price movement more likely represents relatively insignificant range-bound trading or an actual significant trend. Because momentum indicators measure trend strength, they can serve as the early warning signals that a trend is coming to an end. For example, if a security has been trading in a strong sustained uptrend for several months, but then one or more momentum indicators signals the trend steadily losing strength, it may be time to think about taking profits. Here's an example of a 4-hour chart, SGD. Below illustrates the value of a momentum indicator. The MACD indicator appears in a separate window below the main chart window. The sharp upturn in the MACD beginning around June 14th indicates that the corresponding upsurge in price is a strong trending move rather than just a temporary correction. When price begins to retrace downward somewhat on the 16th, The MACD shows weaker price action, indicating that the downtrend movement in price does not have much strength behind it. Soon after that, a strong uptrend resumes in this instance. The MACD would have been helped provide reassurance to a buyer of the market that A, the turn to the upside was a significant price move, and B, that the uptrend was likely to resume after price dipped slightly on the 16th. So pretty much is showing right here that the MACD is obviously showing downward pressure, which is obviously a lot of selling volume. Pretty much MACD goes off of green and volume bars. It's pretty much another version of volume bars. It's just one direction is showing green and one direction showing red. Obviously, they're talking about the 16th right here, which is right here, signaling an obvious reversal from that sell-off. Because momentum indicators generally only signal strong or weak price movement, but not trend direction, they are often combined with other technical analysis indicators as part of an overall trading strategy. Technical analysis conclusion. Keep in mind that the fact that no technical indicator is perfect, none of them give signals that are 100% accurate all the time. The smartest traders are always watching for warning signs that signals from their chosen indicators may be misleading. Technical analysis done well can certainly improve your profitability as a trader. However, what you may do to improve your fortune is spending more time and effort thinking about how to best handle things if the market turns against you, rather than fantasizing about how you're going to spend your millions. In this sense here, I'm going to see if I can actually do a little live trading for you. Now you guys can go this web link here. You can practice actually beating a bot. I'm just going to give you a little example here of watching some of these candles. I wonder if I can put an indicator in here just to show you. Can I? Yeah, I can. Let's do an EMA. Now watch these candles carefully. You're going to see the wicks. I'm going to go ahead and buy in here. Going to cash out. It's obviously got some reversal going on here, so I'm going to watch it carefully. Okay, this is kind of a bullish trend. I'm going to go ahead and buy again. Nope. It was just a fake out. It's a common. Bullish again. Looks like we're going to break out new highs. This is double top. Yep, we're breaking out new highs here. Oh, that signaled to me that that's obviously a neutral right there. This is bearish now. I'm going to go ahead and short it. We're going to cash out that trade. This is very indecision in here. Okay, we're going to go bearish or bullish. Nope, it's indecision. Yeah, we'll go bullish. I think we got bullish here. Indecision again. You see that candle there showing indecision. Obviously bearish. A lot of indecision here. It's going bullish again. I'm out. So I won that. I made a $2,124 profit on it. The robot only made $167 profit or minus. I actually lost 627. I made 2,124 on that trade. So that gives you an example. It's good to practice. You guys can test this link here. But knowing those candles, that's how I judge it. I don't use indicators. I watch those candles. I'm looking for that indecision to show when I close my trade and that indecision when I buy my trade, according to what kind of the candles are representing. It's a good way to practice. It's a good way to learn. I'm going to go ahead and post that link for you guys. In the challenge here. I was showing some of y'all the other day as well. So guys, if y'all got any questions, feel free to holler at me. I'm going to go ahead and end the episode there. But feel free to have any questions. I'll have this recording on for you guys tonight. And I hope you've learned something out of it. There is a lot to learn. So we're going to cover it one step at a time so you guys can hopefully fully learn the process. Thank y'all and have a good evening.